Welcome to the MUFG Global Markets Podcast. I'm John Cook, and I'm joined today by Takahiro Sekido, Chief Japan Strategist for MUFG. It's Monday, December 6th, 2021. Welcome back to the podcast, Sekido-san.
Good to be back.
Always good to have you. So as we approach the end of the calendar year, I thought it'd be a good opportunity and one to take where we could look back at 2021 as well as look ahead to 2022. So why don't we start the podcast off with you taking our listeners through some of the high points?
Yen rates rose in February 2021. The BOJ announced at its January meeting that it will assess monetary easing at the March meeting. Market speculation about yen rates normalizing put upward pressure on JGB rates. The BOJ decided to scale back on JGB purchases from April based on the results of its assessment. But the global collateral funds continue to flow into JGBs, and the upward pressure on JGB rates was offset. Upward pressure on the JGB rates reappeared from September. Japanese investors shifted to falling bonds, and investors began to expect the Fed to start tapering. In a dollar-yen cross-currency basis market, foreigners actively arbitrage JGB asset swaps to manage their dollar funds, and this contributed to dollar-yen basis tightening. But dollar-yen basis has been widening since October, ahead of the year-end, as Japanese hedging their falling bonds and demand for direct overseas investments. In our view, yen swap rates are likely to rise in 2022. We expect economies continue to normalize for the post-COVID era as monetary policy addresses inflations with fiscal spending. Dollar-yen forward will likely widen if the US Fed raises FF rates, mainly because of a widening US-Japan rate gap. Dollar-yen basis will likely widen if Japanese investors continue to buy more overseas assets directly. However, foreigners could accumulate more JGBs depending on the pace of rise for US rates.
And I think that's exactly what we've seen recently. If you just look at the 3-month, dollar yen cross currency basis, it's tightened in from, let's say as wide as 30 to negative 15. So I suspect there's quite a bit of foreign buying of short-dated JGBs associated with that. But let's stay on this kind of forward-looking tack, if you will, and dig a little deeper into 2022. I'm curious what the potential risk events are that our clients should be, looking out for in the year ahead.
The BOJ will likely continue to control JGB rates in 2022. In a fiscal year 22, we will be watching the BOJ's incentives attached to its current deposits, especially firstly, to strengthen the regional banking sector, and secondly, to treat the COVID pandemic, and thirdly, to encourage climate change countermeasures. We do not expect Governor Haruhiko Kuroda to change the range of yield curve control operations during his term. Speculation grew that the BOJ would widen the range for yield curve control operations after the assessment of monetary easing in March 2021. But in fact, the BOJ had stuck to a range of 25 basis points. As it did in 2021, the BOJ may change its interest rate incentives in the first quarter 2022 to cope with regional banking sector restructuring, the COVID pandemic, and climate change conditions. Upper house elections will be held in summer 2022. The lower house elections in fall 2021 resulted in Prime Minister Fumio Kishida staying in office. Japanese corporate and investor behavior could change because of the additional economic measures. And supply and demand for yen's funds, as well as room for yen basis arbitrage could change depending on the fiscal year 22 budget and JGB issuance plans. Risk factors for 2022 include global inflationary pressures and geopolitical risks, and these could affect flow of funds, but inflation countermeasures and economic normalization will likely continue through the post-COVID era.
Great. That's a great rundown of the known unknowns ahead of us, if you will. But I guess I'm curious as a follow-up question. What about the very near term? Immediate December, into January. What's ahead for us?
In December, the MOF will reduce the issuances of 3-month TDBs, as the government has huge surplus funds. Also, the MOF will cut 6-month TDBs after its diet approves the fiscal year 21 supplementary budget and JGB issuance plan. We'll be watching the fiscal year 22 JGB issuance plan to see if 1-year TDB issuances are cut, as well as for details about the array of JGB issuance durations. The government deposit could grow in a fiscal year 21, and a government budget may not be entirely used. This could lead to government debt durations being lengthened. Despite the festering risks related to the Omicron variant, we do not expect an emergency response taken in the early days of the COVID pandemic. The MIF will likely continue to extend JGB durations and limit JGB redemption risks, and we do not expect the fiscal year 22 JGB issuance plan to exert excessive stress on the JGB yield curve, but the MIF's strategic debt management could be a catalyst for the JGB yield curve steepening.
Yeah, this really builds on some of our discussion from last week. But I mean, the short of it, as I kind of understand it, is in the press you hear about increased JGB issuance, and you hear about fiscal stimulus. But the truth is, just because the government has so much yen on hand, really, if anything, it's a lower supply, a lower supply, exercise, which is I think So I think a lot of people are kind of wrong way on this. So appreciate you setting us straight. So I think we're coming to the end here. Why don't we wrap things up with your outlook in the very near term and medium term across yen rate, spot dollar yen, and yen basis?
News about the emergence of Omicron variant has completely upended yen pricing since November 26. Oil prices have plunged, alleviating inflation expectations and causing the dollar yen to fall. On November 30th, Fed Chair Powell displayed a hawkish stance, recharacterizing his transient view of inflation and noting that the Fed will accelerate monetary tapering from the December FOMC. Dollar yen will less likely recover to the 115 mark for some time amid seeming uncertainties about Omicron. OPEC Plus decided to maintain oil production on December 2nd. The U.S. Energy Information Agency stated in its November report that there will be an oil glut from January 2022. Oil prices are likely to drop over the near term. We expect U.S. economic data to remain strong. Growing expectations of a U.S. rate hike will support a stronger dollar. We now expect dollar yen to trade in a 3-yen range, 111.50 to 114.50, with a bearish bias. The Omicron has weighed on the JGB yield curve. Investors will be awaiting details of the fiscal year 22 budget and the JGB issuance plans. Japanese may stay on the sidelines, and downward pressure on yen rates will likely prevail. Yen rates will take on a downward bias from a neutral one. The yen basis curve has tightened. The Ministry of Finance weekly data shows that Japanese unloaded net 1.4 trillion yen of overseas securities in the week of November 21st to 27th. Their selling picked up steam. While Japanese turned net buy of overseas stocks and investment fund holdings by 105 billion yen, their net unloading of medium to long-term bonds grew to 1.3 trillion yen. Meanwhile, foreigners bought a net 2 trillion yen of Japanese securities. Their yen cross-currency flows remain strong. They net bought 2.7 trillion yen of short-term bonds, but unloaded more medium to long-term bonds by 451 billion yen, and stocks and investment fund holdings by 309 billion yen. Preference for TDDs has grown among foreigners. We expect foreigners' JGB flows to dominate over the near term, especially for the front end of the curve, and now expect a tightening bias for yen basis rather than neutral.
Thanks for that. So to summarize, you are bearish on spot dollar yen, bullish on JGBs, and expect the basis to continue to tighten.
Yes.
Okay, perfect. All right. Well, great stuff. Thanks again, Sekido-san, and let's do it again next week.
Okay, thank you for having me, Jan. As always, I'm speaking from Kanazawa, Japan. Thank you.
All right. Well, thank you for listening to the MUFG Global Markets Podcast. Rate, review, and subscribe on Apple, Spotify, or wherever you get your podcasts. And reach out to your MUFG sales rep for any further information. Check back soon for more insights from the Global Markets Research Team.